The global impact of China's housing market collapse is a subject of immense significance, as China's economy plays a pivotal role in the international financial system. The Chinese housing market has long been a cornerstone of the country's economic growth, with real estate contributing significantly to GDP and household wealth. A collapse in this sector, therefore, has profound implications, not only for China but also for the rest of the world. Firstly, thank you for watching, and don't forget to smash that like, subscribe, and notification bell for more global finance uncovered, as we continue to work hard and around the clock to always deliver and improve on our content for you. We would greatly appreciate your additional support by you clicking the like button, notification bell, and subscribe button and joining our channel's growth. Okay, let's first discuss the collapse of China's housing market would severely impact global commodity markets. China is one of the world's largest consumers of raw materials, such as steel, copper, and cement, driven largely by its construction and real estate sectors. A downturn in the housing market would lead to reduced demand for these commodities, causing prices to plummet. This would have a cascading effect on commodity exporting countries like Australia, Brazil, and Canada, whose economies are heavily reliant on exports to China. Secondly, the financial sector, both within China and globally, would face significant risks. Chinese property developers, many of whom are highly leveraged, would struggle to service their debts, leading to a wave of defaults. This could trigger a banking crisis in China, with global ramifications. International banks and financial institutions with exposure to Chinese real estate or who have lent money to Chinese firms could see substantial losses, potentially leading to a tightening of global credit markets. Moreover, a collapse in China's housing market could lead to significant capital flight. Wealthy Chinese individuals and corporations, fearing further economic instability, might seek to move their assets abroad, leading to downward pressure on the Chinese yuan. This could result in increased volatility in global currency markets, affecting exchange rates and international trade flows. The impact on global trade would also be severe. China is a major trading partner for many countries, and a downturn in its economy would reduce demand for imports. This could lead to a slowdown in global trade, particularly affecting countries that are heavily dependent on exporting goods to China. The ripple effects could be felt across various industries, from electronics and machinery to consumer goods.
In addition, the collapse of China's housing market could exacerbate global supply chain disruptions. The construction and real estate sectors are deeply intertwined with numerous other industries, including manufacturing and services. A slowdown in these sectors could lead to reduced production of goods, delays in deliveries, and increased costs, further straining global supply chains already disrupted by the COVID-19 pandemic and geopolitical tensions. Emerging markets would be particularly vulnerable to the fallout from China's housing market collapse. Many emerging economies have benefited from China's rapid growth through exports of raw materials and manufactured goods. A slowdown in China's economy would likely lead to reduced demand for these exports, causing economic slowdowns or recessions in these countries. This could also lead to increased financial instability as investors pull out of emerging markets in search of safer assets. On the geopolitical front, the collapse of China's housing market could lead to increased tensions between China and other major economies. As China grapples with domestic economic challenges, it might adopt more aggressive trade or foreign policies to divert attention from internal problems. This could strain relations with key trading partners, leading to an increase in global geopolitical risks and uncertainties. Furthermore, a housing market collapse in China would have significant social implications. The real estate sector has been a major driver of urbanization and wealth creation in China. A collapse could lead to a surge in unemployment, particularly in the construction and related industries, and exacerbate income inequality. This could result in social unrest, which could have further destabilizing effects on the Chinese economy and its global standing. The global stock markets would also be impacted by a collapse in China's housing market. Investors around the world would likely react negatively to news of economic instability in China, leading to sell-offs in global equities. This could result in a significant decline in stock market indices, particularly in markets with high exposure to China or Chinese firms. In terms of foreign direct investment (FDI), a collapse in the Chinese housing market could lead to a significant decline in FDI inflows into China. Investors may become more cautious, fearing further economic instability or government intervention. This could lead to a slowdown in investment in key sectors such as technology and manufacturing, which are critical for China's long-term economic growth. The real estate market in other countries could also be affected by the collapse of China's housing market. For example, cities like Vancouver, Sydney, and London, which have seen significant investment from Chinese buyers, could experience a downturn in property prices. This could have broader economic implications for these cities, particularly if the local economies are heavily reliant on the real estate sector. Additionally, the collapse of China's housing market could lead to changes in global investment patterns. Investors seeking to avoid the risks associated with China might shift their focus to other regions such as Southeast Asia or India. This could lead to increased investment and economic growth in these regions, although it might also create new economic imbalances. The energy markets would also feel the impact of a collapse in China's housing market. As the world's largest importer of oil and natural gas, a slowdown in China's economy would likely lead to reduced demand for energy, causing global oil prices to fall. This could benefit energy importing countries but would hurt major oil exporting nations, particularly those that rely heavily on Chinese demand. Moreover, the collapse of China's housing market could have significant implications for global climate change efforts. The real estate and construction sectors are major sources of carbon emissions, and a slowdown in these sectors could lead to a temporary reduction in emissions. However, it could also delay China's transition to a greener economy as economic priorities shift towards stabilizing the market rather than investing in sustainable development. Another area of impact would be the global luxury goods market. Chinese consumers are some of the largest buyers of luxury goods worldwide. A collapse in the housing market, which would likely lead to reduced household wealth and consumer confidence, could result in a significant decline in demand for luxury products. This would affect luxury brands and retailers globally, particularly in markets like Europe and North America. The technology sector could also be impacted by a collapse in China's housing market. Many of the world's leading technology companies have significant operations or sales in China. A slowdown in the Chinese economy could lead to reduced demand for technology products as consumers and businesses cut back on spending. This could affect the revenue and profitability of major tech firms, leading to broader impacts on global innovation and technology development. Furthermore, the global automotive industry could be affected by a collapse in China's housing market. China is the world's largest automotive market, and a slowdown in its economy could lead to reduced demand for vehicles. This would impact global car manufacturers, particularly those heavily reliant on sales in China, and could lead to a broader slowdown in the automotive industry. Tourism is another sector that could be affected by the collapse of China's housing market. Chinese tourists are among the most prolific travelers globally, spending billions of dollars each year on international travel. A slowdown in China's economy, coupled with a decline in household wealth, could lead to a significant reduction in outbound tourism, affecting tourist destinations and businesses worldwide. In the realm of global finance, the collapse of China's housing market could lead to increased volatility in financial markets. Investors, fearing the broader economic implications, might seek to move their assets into safer investments such as government bonds or gold. This could lead to fluctuations in asset prices and increased volatility in financial markets, making it more difficult for businesses and governments to plan and invest. The education sector could also be impacted by the collapse of China's housing market. Many Chinese families invest heavily in education, both domestically and internationally. A decline in household wealth could lead to reduced spending on education, particularly for studying abroad. This would impact universities and educational institutions in countries like the United States, the United Kingdom, and Australia, which attract large numbers of Chinese students. Moreover, the collapse of China's housing market could lead to changes in global migration patterns. Economic instability in China might prompt some Chinese citizens to seek opportunities abroad, leading to increased migration to other countries. This could have social and economic implications for both the countries receiving these migrants and for China itself, as it could result in a brain drain and a loss of talent. The global insurance industry could also be affected by a collapse in China's housing market. Insurance companies with exposure to Chinese real estate or those that have underwritten policies for Chinese developers could face significant losses. This could lead to increased premiums and a tightening of the insurance market, affecting businesses and consumers worldwide.
In the realm of international relations, the collapse of China's housing market could lead to shifts in global alliances. Countries that are heavily dependent on China for trade and investment might seek to diversify their economic ties, leading to new alliances and partnerships. This could reshape global geopolitics, particularly in regions like Asia and Africa, where China's influence has been growing in recent years. Finally, the collapse of China's housing market could have long-term implications for the global economic order. As one of the world's largest economies, any significant downturn in China would have lasting effects on global growth and stability. It could lead to a rethinking of economic strategies and policies worldwide as countries seek to protect themselves from the fallout and prevent similar crises in their own economies. Thank you for watching, and don't forget to smash that subscribe, like, and notification bell for more global finance uncovered.